Some basic concepts of macroeconomics. First, let us look at the classification of goods. The first type of goods being final goods. What are final goods? From the name itself, we can conclude that they're for the final users. Okay, they've crossed the complete boundary line of production. No more production is to be done to that goods. That means it's definitely not raw materials. Okay, no more value addition is to be done, and they're ready for use by the final users. Those goods are final goods. Okay, for example, when we buy a pen, okay, then it's a final good for us, obviously, because we are not going to do anything or sell it again. If we're not going to resell it again and use it for our own writing, then it's going to be a final good for us. And the final goods can be bought by consumers also and by producers also. Okay, why do consumers buy final goods? To satisfy their wants. We have so many wants and we want to satisfy them. That's why we buy everything that we buy. Okay, now producers, they buy final goods as fixed assets. For example, machinery, tractor, they use all these in the production process. Okay, but they're not going to add value to the good itself. They're not going to add value to the machine itself. So machine is a final good that the producer purchases. Okay, so the expenditure on final goods is equal to consumption expenditure that's done by consumers plus investment expenditure that's done by producers. Okay, and note it that only final goods are included in the estimation of national income. Okay, now let us look at intermediate goods. What are intermediate goods? Obviously the opposite of final goods, that are still within the boundary line of production. Okay, which means value is still to be added. Okay, look, they can either be raw material. For example, if it's wood, okay, it's wood with a carpenter, then he's going to do something and make chair out of it. Okay, so he's going to add value to it and make chair out of it. Or let's say if a retailer bought a shirt from a wholesaler for rupees 100, and then he is going to sell it in the market for rupees 200. Okay, so value is still to be added by him, because if the consumer buys it from him, then it becomes final good. But right now, if the retailer has got it, then it's still an intermediate good, because he is going to add his own value and then going to sell it in the market. He's not doing any sort of charity here, that he'll sell it for the same money that he got it from the wholesaler in. Okay, so make it a point that the value of intermediate goods ultimately become the value of final goods. Why? See, as we saw here, the wood, it will ultimately become chair, which is a final good. So in the chair itself, the value of wood is considered. If the chair is worth 5,000 and if the wood was rupees 500, then in the estimation of the price of the chair, we've already considered the value of wood, right? So if in the estimation of national income we start counting intermediate goods also, then there will be double counting, because then we'll be counting the value of final goods twice. We'll be counting wood separately, chairs separately, then twice we'll count the value of that good. So that's why intermediate goods are not added in the estimation of national income. Okay, and now the expenditure that's incurred on buying intermediate goods is known as intermediate consumption or intermediate cost. Right, now see, what if our value of output right now is 500, and if our value of and if our intermediate consumption was, let's say, 300 rupees, okay, then the gross value added by us comes to 200 rupees. This is very simple maths and I hope you got it. Okay, look, but here one twist comes into play. The same good may be final also, and that good may be intermediate also. How can one good be final and one good be intermediate? For example, take paper. Okay, if I use paper for writing my projects or anything, then obviously it's a final good, because I'm not going to resell it in the market. But if a publisher buys paper for publishing books, then it's an intermediate good, because he's going to make use of that good and he's again going to resell it, adding value to it. Okay, so for the same example, let us take sugar. Okay, sugar, when we use it in our households for normal cooking, then it's a final good. But when a sugarcane industry buys it to produce their stuffs, then it becomes an intermediate good, right? So it depends on the end use of goods whether the goods are final or they are intermediate. Now let us look at two different categories, that are consumption good and capital good. Okay, so first, consumption good. What is consumption goods? Consumption goods are the goods that directly satisfy human wants. Okay, and there are four types. That directly means we buy them and they satisfy our wants. They can be first, first it's durable consumption good. Durable consumption good means which are there for very long years. Okay, means for 5 years or more they exist and they're of high value. For example, TV, fridge, you buy them, you just don't discard them. You use them for a few years, then you discard them, right? Now next, semi-durable goods. Semi-durable goods means they work for slightly 1 year or a little more than that. Okay, for example, clothes, crockery, you use them for 1 year at least, right? Now next is single-use goods. Now these goods they're exhausted in a single act of consumption. For example, bread, butter, and all these things, milk. So now if you use it again you cannot use the same bread, the same milk that you've already used, right? Now the fourth kind being services. What are services? They're non-material goods, they're not goods, but they directly satisfy human wants. For example, services that teacher provides us, a doctor provides us, a lawyer provides us. Okay. The next category, capital goods. Capital goods are basically the fixed assets of the producers. Okay. Now they can be two kinds of fixed assets. One, fixed assets that's used to replace the current capital stock. Okay, and next, addition to capital stock. Like if say I had 3 machines, okay, and now one of it got damaged, so now I got another machine to replace the damaged machine, so that is my replacement of capital stock. But if I added one more machine just because I wanted to increase the production capacity of my firm, so that is an addition to capital stock, right? And now capital goods, they are not a low value capital goods that are used during the process of production. They're high value goods and they're used for several years. Okay, now these capital goods they involve depreciation. Why do they involve depreciation? Okay, if you get a machine, okay, now for say now it's of 10 lakh. Now if you go and if you try to sell it after 10 years, do you think the same machine is going to be of 10 lakhs? No, exactly, because you've used it so much, so the value of machine has depreciated. So all the capital goods they depreciate. Okay. Now one more thing, look, all capital goods they're producer goods, because in the definition of capital goods itself we said that they're the fixed assets of producers, so certainly they're used by producers, but not all producers goods are capital goods. Okay, see, if this is producer goods, there are two kinds of producer goods. One is capital goods, that's the fixed asset, and another one's raw material. Producers also use raw material to make stuffs, so all the fixed assets that they use are capital goods, but all the raw materials that they use are certainly not capital goods, because they are neither of high value nor are they used for several years. Okay, so yes, capital goods are producers goods, but all producers goods are not capital goods. Now see, consumption goods and capital goods, they are both kind of final goods because they are finally used. Okay, no more value is to be added to them. Now what is aggregate consumption expenditure? Aggregate consumption expenditure means the entire consumption expenditure. So that is the consumption expenditure by household, by government, and by non-profit organizations. Why do households spend? They spend to satisfy their wants. Now we buy anything. Why? Because we want it. If we buy a cloth, it's because we want it. If we buy bread, it's because we want to eat it. Now why do government buy things? They buy things to distribute things. For example, midday meals. Government has a scheme of midday meals. For that, they have to buy meals. They buy defense goods and so many other kinds of goods. Okay, why do non-profit organizations buy goods? For charity, of course, like temples, NGOs, so they buy goods for charity. So the entire consumption expenditure in an economy, these three institutions or people, they buy goods and they buy it for the various purposes that we've just discussed. Next is investment. What is investment? Investment is the increase in capital stock. Okay, now we know from our basic knowledge itself that investment, like if we say invest in the shares of a company, it means we are going to get some value from it in the long term. We are going to get more things out of it. So what is capital stock? Capital stock, it's like the machine or things like that, and if you invest in one machine, then it's going to help you produce so many units of output from that one machine. So investment is also called capital formation, because if you invest, you're making capital for yourself in the long run. Okay, so from the viewpoint of economy, let us see what is investment. Investment is the total production of capital goods during an accounting year from the viewpoint of economy as a whole. Okay, now investment also has two components. That's first one being fixed investment. What is fixed investment? Fixed investment is the stock of fixed assets of producers. They are known as fixed investment. For example, machines, tractors. Okay, now how do we tell how much increase has been in the fixed investment of a producer during a year? It's by the closing value of the fixed assets of the producer minus the opening value of the fixed assets of the producers. That gives us the increase in stock during the account year for the fixed assets of the producers. Very simple, right? Now see, investment is also called as capital formation. So fixed assets, we can also call it as fixed capital formation. Very simple. Okay, now what is the significance of fixed assets? The significance of fixed assets is that it raises the production capacity of producers. if you have one machine, then say you can produce 20 units of a thing per day. But then if you get two machines, you can produce 40 units. So definitely it decreased your production capacity, and it will lead to higher level of output in the economy because you're producing more, and it will lead to higher level of economic growth, higher GDP, certainly. The next, inventory investment. What is inventory investment? It's change in the inventory stock. Inventory stock consists of raw materials. They consist of raw materials, semi-finished goods, that's work in progress, and they consist of finished goods. Okay. Now see how can we determine the amount of change that has been in inventory stock during a year? Simple, closing stock value of inventory stock minus the opening stock's value of inventory stock, that is equal to increase in inventory stock during a particular year. Okay. What is the significance of inventory stock? First, we saw that inventory stock has three components. Okay, and the work in progress, finally it becomes finished goods. So first we look at the significance of raw materials, then finished goods. The significance of raw materials is that it helps us in uninterrupted supply of inputs to producers. See, if they have raw material, then they don't need to buy input every time from the market. Okay, and they can avoid day-to-day purchases, and sometimes in markets the rates are very fluctuating. Sometimes the rates are high, sometimes they are low, sometimes the raw materials may not be available. So if producers already have a good amount of raw materials, they need not worry about these things. And if they have a good supply of finished goods, then it can help them to meet the future demand for their product if they already have good amount of finished goods. Okay, now see, not every stock that they have is desired inventory stock, means not that they wish that they had the stock. Okay, suppose if my target was to sell 1000 shoes during the year 2020. Okay, but I could only sell 800 shoes, so I still have 200 remaining in my stocks that are left unsold. Okay, so this is my undesired inventory stock because I thought I'm going to sell it and make money out of it. Okay, but the demand was not there for these 200 shoes, so it's wasted, and yeah, it's undesired, it's unplanned, and it'll lead to losses. Okay, now see, gross investment is equal to net investment plus depreciation. Let us understand what is each of these.